Good afternoon, everyone. Thank you for joining us today for our monthly webinar. Today, we'll be focusing on market insights with a very special guest. Now, before we get there, let me introduce myself. My name is Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers and one of your co-hosts for today's session. And my co-host and panelist for today is John Mark Young, our President and Co-Chief Investment Officer. Normally, John Mark and I would be really excited to sit down together and have this really nerdy data discussion, but I'm really more excited to introduce to you all our speaker for today. So it is my pleasure to introduce you all Brian Levitt. Brian is the Global Market Strategist at Invesco. In his role, Brian leads the development and communication of the firm's investment outlooks and market insights across all of North America. He's also the mind behind Invesco's compelling wealth management conversations program, which helps investors navigate emotions and remain aligned with their long-term investment plans. He's authored the financial literacy program at Invesco, through which he works closely with families to strengthen personal finance understanding. Brian also co-hosts Invesco's Greater Possibilities podcast and joined Invesco when the firm combined with Oppenheimer Funds in 2019. He has an MBA in Finance and International Business from Fordham University and a BA in Economics from the University of Michigan. Needless to say, Brian has a wealth of knowledge that we're really looking forward to tapping into in today's conversation. So let me set the stage for today's discussion. We've structured today's discussion a little bit differently than our previous webinars. So we'll start off with Brian, who will spend some time walking us through the current macroeconomic environment by highlighting the evolving economic trends. And after that, we'll sit together and have a virtual fireside chat. So grab some tea, grab a nice coffee, whatever you like. What we'll do is we'll focus on key themes, and we'll really want to make this very personal for you all. So we'll focus on a lot of the questions that were submitted by our attendees. And so what I want you to take away from today's discussion is I want you to walk away with a clear, data-driven analysis paired with real-world perspective. And the whole focus here is that if you are an investment professional looking to refine your outlook, or if you're an investor trying to get a better understanding in today's complex market, today and here is a right place for you. So as I mentioned, we want this to be very interactive. Please remember to use that chat function on your screen to submit any questions. And if you're watching this on YouTube or any of our social media sites, please make sure to hit that subscribe button below so that you're updated with the latest content produced by our teams. And remember, don't forget to hop on to Invesco's media site and subscribe to their incredible content as well. So without further ado, please join me in giving a warm virtual welcome to Brian Levitt, who will now take us through the latest market developments and what they mean for you and your investments moving forward. Brian, take it away.
So thanks, Summit. Thanks, everyone, for joining this conversation. I'm going to walk you through our playbook at Invesco for how we think about where we are in the current environment and what the implications are for markets. So I'm going to do this in maybe 10 minutes, and then I really want to get to the conversation part of this. But real quick, just how did we get here? I know you've lived through it, but just a reminder. The second, where are we in the cycle? And I want to be clear what I mean by that. Cycles can last 5, 10 years. So where are we? Is there a recession coming, or is this more a middle part of the cycle? Questions 3 and 4, the direction of the economy and what the policy response would be, gives you more of an idea of what markets are likely to do, call it over the next 3 to 6 months. So we'll spend some time there. And then, a couple of thoughts on market implications, and then again, back to the conversation part. So just a quick look at how we got here. I thought it might make sense just to look at the last 3.5 years, actually a little bit more than 3.5 years now. They're very illustrative in terms of how markets work. 2022 is a bit in the rearview mirror now, but it's still worth assessing what happened that year. And 2022 was just a year in which things got worse relative to expectations. And what I mean by that was inflation was stickier than many had expected during the supply chain challenges. And the Federal Reserve had to raise rates a lot and quickly. And when they do, valuations tend to get hit. So that was worse. There was nothing magical about 2023, but it was just a year where things got better relative to expectations. Inflation came down quicker, and the Federal Reserve was able to stop raising rates. 24 was quite a year. 24 was a year where the economy just kept going and inflation was stable. All right, so that's a really nice backdrop. And I would argue the backdrop coming into this year was very positive, about as positive as I had seen. And then we've been grappling with the policy uncertainty, both the concern, the expectations of tariffs, then the Liberation Day announcement, then the pause on April 9th, and investors just trying to calibrate or recalibrate what that means. Year to date, as of right this moment, we're actually up 9.6%. So the policy uncertainty created volatility, as it almost always does. After back-to-back 25% up years, people will ask me, when does the volatility come? It almost always comes when there's policy uncertainty. This year was true to form, and yet the economy continues to remain resilient. So that's how we got here. From there, it's worth assessing the business cycle. Again, I want to be clear. When I talk business cycle, I'm talking multi-years. I'm talking, again, 5, 10 years. I would say this cycle started really when we reopened from COVID in the middle of 2020. So when you look at business cycles, you want to get a sense, is it early? I don't think we're going to argue it's early. Is it middle? Markets tend to do just fine, or is it late in the cycle? And as we get later in the cycle, I tend to check off these boxes on the right. Typically, as a cycle evolves, you get a lot of leverage and excess in the economy, meaning businesses borrow too much, the consumer borrowed too much, the banks made too many bad loans, the home builders built too many homes, businesses stocked up on too much inventory. That's not today's environment at all, I'm going to argue. So it's not a story of leverage in excess. Typically, when you get leverage in excess, the Federal Reserve raises interest rates. That's step 2 to slow down the economy, kill inflation. We got that in 2022, but that's not what's happening here. If anybody listened to Jerome Powell, Fed chair at Jackson Hole, he's actually talking about lowering interest rates, which is quite different than late cycle. The third thing that starts to happen at the end of a cycle is credit spreads widen as growth slows. What does that mean? That means corporate borrowing costs relative to a risk-free rate or a CD rate go up. You're less likely to want to lend money to below investment grade companies or even investment grade companies. That's not happening. And then finally, the fourth thing that tends to happen is the bankers tighten lending standards. So I'm going to argue that none of that right now is happening. So there's a lot of concern I hear from people, and we'll get to that in a second. But in terms of, is the business cycle ending? I come down on it unequivocally to say no, that does not appear to be the case. Now, just to look at it in a couple of charts, I'll give you a sense first what had people worried. On the left, this is just a representation of the U.S. Treasury yield curve, so 10-year minus 3-month. When you go negative on that, it's usually because the 3-month rate has been pushed higher than the 10-year because people are afraid of inflation. That's how you get recessions. So if you look at 2022, 2023, we did go down into that territory having to kill inflation. It's now normalizing, and the way it normalizes is the Fed lowers rates. Now, sometimes the Fed's lowering rates to respond to a recession. That does not appear to be the case this time. And if you look at the chart on the right, this is what's giving me a lot of comfort. The light blue line there is what high yield businesses borrow at, essentially. So below investment grade, riskier businesses, what do they borrow at? And If you see those shaded areas, which are recession, you tend to notice the light blue line goes up ahead of the recession, and this is on the left y-axis. So what businesses have to borrow at increase ahead of recessions because the market starts to get worried. That is not the case today. If anything, the borrowing cost of businesses at the light blue line at the far right is about as low as it gets. Now, that sometimes scares people, but note that you can go years with it at those low levels, and that's promising. Now, what is the dark blue line? The dark blue line is on the right y-axis. It's asking bankers, are you tightening lending standards? And so that goes, call it from negative 40% up to 100. How do you have a negative 40? It's really, are you tightening or easing? So when you're negative, you're easing. When you're positive, you're tightening. Right now, you're at about a couple of percent tightening standards. That's not a recession. A recession is when you have 50 or 60% of the bankers tightening lending standards. So hopefully that wasn't too inside baseball, but these are the types of things that I watch. The other thing worth noting, if you look at what's been going on in the bond market, if you look at a 10-year treasury rate, you can break that up into the real yield, which reflects the growth component of it, or the inflation break even, which is in essence the bond market's expectation for inflation. So what you've been seeing lately is the real yield, the dark blue, coming down. So growth is slowing. Fortunately, the light blue line, even with tariffs, is generally stable. So unless you're going to get a big pickup in that light blue line and the Fed's going to have to raise rates, it's very unlikely that you will get a recession here. So that's the good news over the next 5 to, call it 5 years or so. I'm, thinking of these longer cycles. Now, I don't want to confuse, but just to say within cycles, you go through different phases. There's moments where it's a big recovery and everything feels great and most assets go up. You have these expansions where you pick up above trend and keep going. You have slowdowns. You have periods that I'll call contraction. I don't know if contraction is the absolute right word. It's not a recession. It's just you're kind of pointing towards below trend growth and weakening. The good news is you're in recovery and expansion and slowdown 85% of the time. Stocks do fine in those. Right now, nothing terrible, but I would say we're picking up a little bit of a contraction. What does that mean? Look at the light blue line here just to get a sense of what I'm talking about. The light blue line is a global leading indicator, and I magnified it on the right there just to give you a sense of what the last 5 years have looked like with COVID. So don't even worry about the dark blue here. Let's just focus on the light blue. That line collapses with COVID, no surprise. That's a contraction. It recovers quickly until it gets up to that trend line, the dark black line. That's the second half of 2020. You're above the line in 2021. Inflation, you start to slow. And then you've been pretty stable for the last few years, but below trend. Okay, so it's not a recession, but it's not very exciting with regards to economic activity. There's just not a lot happening. Again, no recession, but there's no real catalyst. If you think about it by different countries or regions, the easiest thing to know on this chart is anything to the left is pointing towards below trend growth. Now, if you're in the left top, that's more like a recovery. You're improving. If you're in the left bottom, you're deteriorating. So nobody's really in the left bottom. You're just all kind of bunched together. Basically, it means nobody wins in a trade war. And so there's just not a lot happening in the global economy. Everyone's kind of pointing towards below trend growth, but no real significant deterioration. So that's good. Probably means you need support from the policymakers. It also explains why you may have noticed that the markets have been somewhat focused on large cap, mega cap growth again, because there's no real catalyst emerging for other parts of the market. If you want to get a sense what leading indicators mean, and maybe they're starting to recover a little, CEO confidence is on the left. It plunged after Liberation Day, bouncing a bit. Small business optimism, same story. Consumers not feeling that great on the right, and that's largely because of the price of goods.
I know that a lot of concerns about whether this is going to be inflationary. Can the Fed really lower rates? I view tariffs as a price shock, not sustained inflation. And so what I boil it all down to is that doesn't show signs that there's a recession coming. That's very good news. There's not a lot of activity happening globally. When you're in that environment, you want policy easing. I think that's what the markets are looking for. The challenge is, can you ease if there's inflation coming? The good news is I don't expect a wave of inflation. I expect price shocks. That's generally what the bond market is telling us too. I showed you the inflation expectations in the bond market, which are pretty stable. So what do we do with this as investors? One, if you're not coming to the end of the cycle, you want to continue to be invested in risk assets, right? Most of us aren't so tactical that we want to time these things anyway, but you want to continue to be invested in risk assets. When you're in an environment where there's not a lot of economic activity happening, tends to favor growth, larger cap, higher quality businesses, which you've been seeing, like the NASDAQ index is outperforming again. But I want you to note what happened on Friday when it looked like the Fed is going to start lowering interest rates and the 4% rally you got in small caps. That's how these things typically work. You need a catalyst. And so what our expectation is, again, right now, this contraction, higher quality trade, if we're right and inflation does not reemerge and the Fed can start lowering rates and you get a pickup in activity, that's when you get back into those recovery trades. And that's when you start to perform well in things like small and mid cap. The dollar should likely to keep going down, which can help international investments. So I think that's what a lot of us expected coming into this year until Liberation Day shut that down for a bit. And ultimately, my expectation is, we may not be there precisely at this moment. I think as we move through this year into next year, it's going to start to feel more like a recovery trade and the continuation of this cycle.
Great. Thank you for that, Brian. You highlighted very, very briefly, and I'm sure we'll dive into this more. The action that we saw on Friday was really great, right? We saw the NASDAQ reaching all-time highs. We saw the S&P 500 getting very close to all-time highs, and we've seen that story so many times throughout this year, right? We're reaching all-time highs and continuing to see it grow and grow and grow. So, as an investor, we always like to buy low and sell high. So what are your thoughts about investing now in this environment when we're sitting at all-time highs across most indices out there?
Yeah. But the reality is, indices are a reflection on the economy and market. They don't mean revert. So if you think the world is going to get better over time, you should expect there to be many, many new highs in the market over the course of your life. When I say that they don't mean revert, they don't fall back to some average. In fact, if you look back, and we do have a chart on it, if you look back to 1957, which I did on the chart on the left, you'll see every one of those bars represents a new high. And so we counted them up, and there's about 1,300 new highs since 1957. That's the equivalent of once every 2 weeks. So you should expect many, many new highs over the course of your life. The concept on the right, it probably gets even more so at the question you're asking. We did a study going back over that full time period and said, okay, how did I do over the next 1, 3, and 5 years if I invested on the new high that was being reached versus if I just invested on every non-market high day? And the dark blue bar over 1, 3, and 5 goes higher than the light blue bar. So what does that mean? It means you actually did better investing when the market's at a new high than you did just investing on random days. It suggests, I think what a lot of us know, momentum is a big driver of markets.
And we've over the last 3 to 5 years, we've definitely seen volatility in the market. Many young investors that have gotten into the market in the 2020s, saw some pullback certainly early on, but we're continually reaching these new highs, and many of them haven't really felt what a bear market really feels like. Do you have any advice or any thoughts on young investors that are out there?
Yeah, well, look, I mean, I think the reality is they should expect some bear markets over the course of their life. They're not nearly as prolonged or common as bull markets typically are. When they happen, they tend to emerge quickly, and you get these types of drawdowns in markets. The bigger the drawdown, the longer it takes for it to recover. So, these 20% declines in markets happen sometimes, economic downturn, but you recover from them in a year or two, right? And so they need to realize that, the two that you probably want to avoid are '08 and 1973. '73 was a policy mistake, prolonged stagflation. '08 was a leverage-driven crisis. You went down 50%. You didn't in both instances, and you didn't recover for a half decade or more. So I think the way investors should think about it is they should know that these things do happen. Nothing, trees don't grow to heaven, but you can structure portfolios to help dampen some of the concern that you have, or if you're somebody such as myself who wants long-term accumulation in the portfolio, long-term growth in the portfolio, I simply need to know that these types of things are part of, it's almost like the cost for the volatilities, the cost for these, nice long-term gains that we're able to generate. I mean, if I think of when I graduated college, '98, if you had told me at the time that over the next 20 something years, I would see 9/11, a global financial crisis, a European debt crisis, the UK leave the European Union, and the worst pandemic in 100 years, I might not have thought the market would be at an all-time high, but that's the way it works. So you either, if you can't take the volatility, you've got to have things in the portfolio that can dampen it, whether that's cash, whether that's bonds, right? Or you've got to steel yourself for it and study the history of markets to better understand how these things play out over time.
Brian, I thought it was pretty interesting. Tom Lee was on the Compound this last Friday, and they're a research partner of ours. We use them for some of the research we do, and they talked about when there's a waterfall decline in the market, the ratio. Now this is like non-recessionary, which I guess technically when you have these declines, you don't really know is it like in April. I think every economist was saying this is going to create a recession, which is why the market instantly priced in, a recession into it within days. But so I guess that's somewhat unknown. But when you have these waterfall declines like that, they did the math on all of them that were non-recessionary, and the ratio is like 1.4 to 1.8, meaning that if it's a 2-month decline, then essentially it's, let's call it a 3-month recovery. There, it's, like we often hear about like a K-shaped recovery, a U-shaped recovery, and the reality is, unless it's recessionary, it's always a V, always.
Yeah. Well, and even if you think about March 2020, which was recessionary, it was still a V.
Yeah.
Right. It's when, when I bring up 73 and '08, because those are the periods where you have sustained challenges that you have to work your way through. Like '08, we had to de-lever the economy. So that felt more like call it a square root recovery, right? Or an inverse square root. But yeah, you're right. In most of these instances, when investors are getting concerned because of headline risk, you get these V-shaped recoveries. And the one that we just did, that was one of the fastest recoveries we've seen. That was like 80 something days. You were back at an all-time high. And John Mark, you know as well as I do, that's a big challenge investors have because they end up wanting to bail at the inopportune time. They want to bail at the time when yeah, this is the chart of it. So they want to bail right when the policymakers are coming in with the response. So if you look at the chart, the pink line is what we just did. If you notice, February 19th is that 0 point. That was the market high at the time. And you are hovering around 5 to 10% down somewhere ahead of Liberation Day. Actually, at Liberation Day, you were only down 5%. After that happened, the market fell almost to 20%. So you're right. It was a market that was basically saying, if we keep going this way, we're going to have a recession. And so then Trump said, okay, 90-day pause, and then you recovered in 88 days, right? So it's a pretty classic V-shaped recovery, even faster than these others. And, I don't know if Tom Lee said this, but typically when you get these V-shaped recoveries, it's quite bullish for markets over the subsequent periods.
Yeah. What do you think about the concept of it feels like just lately, when I say lately, like the last 5 years, it's like everything is so quick down, so quick up. And how much of that is tied to the just the change in the US's savings habits as it relates to retirement? 20 years ago, 30 years ago, even '08 that you and I, lived through and had to deal with. I mean, that was a seminal moment for me because it's like I'm right starting the industry in 2007 and then boom, '08, wipes out. And I'm like, this is a terrible career. Because it's everybody's crying all the time and you never hit your goals. But but now it's like, because we're so oriented towards a savings culture as it relates to our retirement, it's like every 2 weeks, regardless of what the market's doing, the 401ks are dropping money in, and more of that's happening. And is that part of the story of what's speeding everything up?
I'm not. No, I'm not. No, I'm not. I'm not going to entirely embrace that because that would suggest that we couldn't have a more prolonged downturn. I would say we're in a very different fundamental place than we were in '08. So I would say that the reaction that the regulators had to '08, meaning that you regulated the banks so they weren't taking on excess risk. The banks felt like they had to keep interest rates very low in order to support the economy. Consumers and businesses locked in low interest rates. So nobody really got over levered. Nobody really got to this point of just too much excess and leverage in the economy. And the other thing is, what was the big lesson learned from the global financial crisis is you got to respond as a policymaker quickly. So perhaps that, so will we have another day, even with all of us investing every 2 weeks? Could you have another day where you have more of a sustained downturn when the economy becomes over levered at some point or too much excess? Yeah, I think you still can. But it's just a more fundamentally sound system that we're operating within right now.
Speaking of fundamentals, Brian, we hear a lot about the market valuations, and we hear that the market PE values are too high right now. What are your thoughts on that?
Well, on the S&P 500, they're elevated compared to average. Now, I know a lot of people want to use a 50-year average on the S&P to determine whether you're expensive. I would say it makes more sense to maybe think, since the internet, maybe the last 20 years or so, 30 years. But the S&P is trading at an elevated valuation compared to its average. So call the S&P at 25 times earnings or so, and the average is somewhere around 17, 18. So that's what you're seeing on the left bar there. If the bar is higher than the average, you're overvalued. But I think, as most people know, the S&P is a market capitalization weighted index, meaning the biggest companies comprise the largest percentage. And so we had gotten to a point when the top 10 names were like a third or maybe even more of the index. And so investors have been perfectly willing to pay up for the earnings of companies like Meta or Nvidia or Microsoft, companies that seem to be at the fore of this new AI revolution. And so, that's more, to say they're overvalued, that's more of an individual stock question around those names. Will those companies grow into their earnings? The next bar you're looking at there is the same 500 companies equally weighted. So every company is 0.2% in the index, and you're not really overvalued, right? You're kind of sitting there. So the way I always learn to think of this is look at the median stock. Is stock number 250 overvalued? I don't have to look at the median stock anymore because now there's an equal weight index. So we just look at that. If you want to look at mid caps, small caps, EFA, which is basically developed markets, predominantly Europe, and the EM index, none of them are all that expensive. So it's US large cap. One of the reasons why I harped on the leading indicator for a while, which remember I showed you was pretty stable, is because in that below trend stable environment, people bid up growth companies, and that's what the S&P 500 has become. In order for things like equal weight, mid, small Europe to outperform, you need some catalysts. And I think that would be lower rates in the US, an easing cycle in the US, and a pickup in global economic activity. That's when you can start to unlock some of the value that exists outside the US.
So do you feel that there are other factors that will drive markets or that will drive stocks further higher?
Well, I usually boil it down to, is growth pretty resilient, is inflation pretty contained? Growth plus inflation is nominal GDP. Nominal GDP normally equates to corporate profitability. If companies are profitable, then stocks should go up. So this is a chart looking at this earnings, the multiple on stocks. So that stars at about 23, 24 times $265 earnings. So that's about your current estimate. I showed you the recession estimates. What would have to happen, in a worse, do recession earnings go down to 205? Wall Street's estimating $300 earnings estimates in 2026. And so that's not, that doesn't have to come to pass. But the way to think of that is you're trading at roughly 21, 22 times forward earnings. And is that all that excessive, considering the potential growth wave related to artificial intelligence that we could be heading towards? So that's what investors need to contemplate. I'm not overly concerned about valuations. They're not timing tools. And again, the equal weight index is trading at a pretty reasonable valuation.
I was thinking about this. We saw a lot of activity, obviously, on Friday, as you mentioned. John Mark alluded to a little bit as well. And specifically, we saw small caps do really, really well, right? Small and mid cap on Friday, specifically with obviously the announcement from, or the expectation with the Fed potentially lowering interest rates. So can you talk a little bit about that? On what are your expectations? What do you believe will happen with interest rates? Potentially this next cycle, or in September we'll see a cut. But what about for the rest of the year? What are your thoughts?
I expect interest rates to slowly come down on the short end of the curve. I think the Fed is gonna, you may wonder why, but if you think of the 10-year Treasury at 4.25 or 4.30, the Fed funds rate probably should not be as high as the 10-year Treasury rate. We would categorize that as restrictive. Why? Because regional banks want to bring in deposits and lend money and make money on the yield curve. So you don't want short rates to be the same as long rates unless you think there's a big inflation problem coming, which I don't. And so what the Fed would want to do is bring rates down. It's not going to have a huge impact on economic activity, but it starts to give you more of a normal yield curve, which helps regional banks. It helps any small businesses that need to borrow money over time. It helps any leveraged companies that need to borrow money over time. So it's worth doing it if you're the Fed and the labor market's slowing a bit, the job market's slowing a bit, and why should you be so restrictive? Probably makes sense to bring rates down. And usually you have about 50 to 75 basis points or 0.5 to 0.75% between the funds rate and the 10-year treasury. So that would say your neutral rate's probably around 3.5 or so. So I think the Fed's going to look to get there. Look, if you have a recession, it's going lower than 3.5, but that's not what we're suggesting. So what are we looking at here? This is, in essence, call it the 10-year after the first interest rate cut, which we had about a year ago now. The light blue is if you don't have a recession. What does the 10-year usually do? The dark blue is if you have a recession, and the pink is what we've been doing. So it's kind of tracking the no recession, not perfectly, but it's sitting around where the no recession is. So I think the 10-year is reasonably priced. I don't see any reason why the Fed funds rate has to be that high. Start to bring it down. And again, that starts to benefit smaller and mid-cap businesses. And it also tends to make the dollar less strong against other currencies because and money's going to go to where it's treated best. So if the U.S. yield is higher than the rest of the world, money's going to go to the dollar. If the Fed starts bringing rates lower towards the rest of the world, then investors don't have to put all their money in the dollar. That might concern some people, but the dollar's very rich right now. It would be probably helpful to our multinational businesses, would certainly be helpful for European equities start to, and emerging market equities start to, if the dollar can moderate some.
Yeah, you know what, actually, in relation to that, Brian, one of the things we saw in April was there was this whole narrative out there that the world was shunning U.S. stocks, U.S. credit. Were we going to see a massive sell-off of treasuries from international, countries, the central banks, large investors, institutional investors? But I think like one of the things that has surprised me recently is like Torsten Slok. He's the chief economist at Apollo. The other day I was reading something. He said global appetite for American stocks and confidence in the American economy are proving to be far more resilient than a lot of the political narratives were suggesting early in the year. And in this note, he wrote to his clients the what we'll call the sell America trade. He said it didn't even make it past April because the 10-year treasury would rise throughout the day. It's like people were selling, and then it seemed like it would fall at night as foreign investors, to your point, were buying those assets because much better rates, better credit quality, presumably than their home countries, and in his mind, of course, he may be talking his book a little bit here, being that he's at Apollo, but he was saying our private debt market is really not replicated anywhere across the world. Mm-hmm. And so obviously you're getting significantly higher rates in the private debt market there. So could you agree with that will continue to bode well for the U.S. markets? And maybe like that would be his argument, I think, for U.S. dollar strength and continued U.S. stock market dominance. Our friend Meb Faber at Cambria is getting ready to come out with the first ever equally weighted. So you showed us the equally weighted S&P 500 a few minutes ago. He's going to show us the first ever equally weighted MSCI like ACWI, an all world index there, including the U.S., which of course still be 60% the U.S. I think there. But is that positive for us on the U.S. stock market side of you're still just getting a lot of international demand for U.S. stocks and U.S. bonds?
Yeah, I never bought the whole end of U.S. exceptionalism story. there were two things that were driving the end of U.S. exceptionalism for the most part. I mean, what's been American exceptionalism for the last 10 years? It's largely been our country has been willing to provide more fiscal support than any other country during challenging times. Okay, especially COVID. And two, we have just these unbelievable growth businesses that grow earnings far beyond what anybody else in the broad market's able to do globally. Okay, so what called that into question this year? The two were one, DeepSeek, right? So do we still need all those high-end NVIDIA chips if they can do it on the cheap? And then the second was, is the U.S. done with fiscal stimulus, and are investors ever going to understand the rule of law in the United States? The reality is, some of these policy changes, I would say, aren't necessarily ideal in terms of creating optimal economic output in the U.S. But the U.S. still looks better positioned than most for a couple of reasons. One, growing population. A lot of the Western world does not have that. Some of the Eastern world doesn't have that, and innovation. And so the regardless of the environment, the businesses here have continued to be able to innovate. And so I would say bet against America at your own risk. The international trade is more about they've been unloved, and they've been unloved because the dollar's been so strong. So if you're in an environment where the Fed is easing and the rate differential between the U.S. and the rest of the world starts to come down, maybe the dollar just doesn't strengthen, or maybe it even moderates, and that's how you can start to do well as an American investor in Europe, where that currency is holding up or appreciating. You translate that back, you've done well on it. So that's where the excitement comes around that. With reality of the dollar, if anyone took stats class, the dollar is still trading more than one standard deviation above its average. So if you remember the bell curve, the one standard deviation are those kind of rare events that don't happen that often. So I wouldn't be all that surprised if the dollar didn't strengthen from here.
Right, we have been in a very strong global economy, and we've seen the impact, or actually the fear, that was driven in April with tariffs, the announcements of tariffs, and what was happening, and the potential of what could happen, and we're potentially seeing a little bit of that impact now. But I'm kind of curious to hear your thoughts. You mentioned earlier in the conversation that nobody wins in a trade war. So can you talk a little bit about the risk of tariffs in the business cycle and how it all comes together for us?
Yeah, I don't like tariffs from the perspective of the more free trade you have, the more optimal outcome you're likely to get. Now, I'm saying that as somebody who studied economics, not somebody who's a politician in this country, okay? Because there may be reasons for it, right? And that's up to the voters and the politicians to decide. If you want to defend national security, right? If you want to defend certain industries, if you want to protect certain communities, that's not for me to decide. There may be reasons for them, but you have to realize there's a cost to it, right? So this is the tariff rate going back to the 1800s. So we are, this is Smoot-Hawley level. We're as high as we've been since the 1930s. And I've shown you a few dots there on the end just to show you that they bounced around a bit. So it's really hard to make assessments on this because they've been bouncing around. The current estimate's about 18%. That's a significant move from where we were, right? Look at the end of 2024 where you're all the way down there at the bottom. So you have to expect a less optimal outcome. What happens is businesses are going to have higher costs of input, right? They're going to pay tariffs on, parts that they may source from overseas. So that's going to cost them more money. They either have to eat that, meaning their profit margins shrink, or they pass it on to the consumer, meaning the consumer faces higher prices, or both. The good news is U.S. imports are not a huge part of our economy, right? But it still will create a less optimal outcome. You're going to get slower growth, which we're starting to see in the job market. And you're going to get some prices pick up in certain items, tariff impacted items. So neither of that is ideal or optimal, but I think as long as businesses know the rules of the game, they can make adjustments, consumers can make adjustments, we can get through it. You won't have the same level of activity you otherwise would have had, but it doesn't have to drive you into a recession. What would drive you into a recession is if it keeps changing over and over and businesses just can't put plans in place, consumers can't put plans in place. That to me is a bigger risk than the actual tariff level.
Great points. Brian, no, one of the things I think we've heard a lot about is that tariff income can help potentially offset the U.S. debt. Now, we've heard a lot of conversations, a ton of different headlines talk about this $37 trillion that we have in debt. And, many of our listeners, most of our team, we're all Dave Ramsey followers. And one of the things he always says and jokingly says that, if you're spending like you're in Congress, you're never going to get out of debt, right? And so I'd love to hear your thoughts on our current state. Where are we? And can you kind of give us an idea of what you think the future is going to hold, or what that looks like, or just kind of give us your thoughts on the current U.S. debt environment?
Yeah, I like the Dave Ramsey line, but I think it's important to note that the U.S. government is not doesn't operate like a household, right? If I need to keep borrowing money, there's not insatiable appetite to lend me money. There's an insatiable appetite for the world to lend money to the U.S. government because it's viewed as being stable. It's viewed as being safe, it's deep, it's liquid, you'll get your money back plus interest, and they'll try not to erode it too much with inflation. So there's an insatiable appetite for it. I just want to use a couple of numbers maybe to just ease some concerns. $40 trillion sounds like a very large number, and that's where we are heading. I will tell you, when I joined this industry, the national debt was $5 trillion. And there were people back then who were trying to tell me it was a huge problem. I didn't understand why it was a problem then, and I don't understand why it's a problem now. $35 trillion later, and U.S. interest rates are 4.25%, and the U.S. dollar is the world's strongest currency. So somebody has to explain why for the last 30 years, everyone's been telling me it's a huge problem, but it hasn't come to be a problem. So here's how I've helped myself get over that. People talk debt to GDP. I think that's the problem. People are, debt is a balance sheet item. GDP is what you make in a given year. Okay, so if you want to think about your debt to the assets of the country, just think simply, what's the total household net worth in this country? It's about $160 trillion. What is the military worth? What are all the federal buildings worth? What's the gold worth? What's the nuclear arsenal worth? What are the national parks worth? But the US has a ton of assets, very wealthy country, but even just simply 40 trillion to household net worth of 160 trillion, I hope that starts to ease people's concerns. Plus, we talked about the insatiable appetite for US debt. Remember, a decent percentage of the US debt's going to be owned by the government. Another decent percentage of it's going to be owned by entities that have to own it, like mutual funds, like pensions, endowments, like financial institutions that are regulated to own it. And then the remaining 25% is foreign investors, the Japanese, Germans, UK, the Brits, all allied countries, all have lower yields than we do. So that's not a big issue. The final thing I want to say on it is, I think most people know that the biggest spending is the social safety net, so Social Security, Medicare. Okay, and if people want to cut that, probably creates other issues, right? So that's probably money well spent if people can have comfortable retirements, but you don't want people sick in the streets. But the challenge is the math starts to become less optimal after 2035. All you would have to do is raise the retirement age or get rid of the taxable maximum or change the cost of living adjustment, or, people act as if there's nothing we can do. And there's plenty we can do. And I think the bond market realizes that there's plenty we can do. So I have never in my life lost an ounce of sleep over the US debt. And then the final point on tariff revenue, that is a positive, right? I said I'm not a proponent of tariffs because it creates a less optimal outcome. That is a positive unless it creates a less optimal outcome and you're collecting less in income and corporate tax. So it's a trade-off, right? And we'll ultimately have to do that math, and the voters can decide. I suspect, if I were Trump too, I'd be touting the revenue we're bringing in, but nobody says, what did you lose in economic activity and what tax might you have brought in on that?
Yeah.
So that's also worth considering.
Yeah, that's right on cue, Brian. I don't consider myself like a blogger or writer, but I think one of the best articles we wrote was in June of this year, where we wrote, it was titled "The Bull Case for the U.S. Debt Situation," where we basically said exactly that, which is you're comparing a debt to an income. You need to compare income to income, balance sheet to balance sheet, and yeah, when you look at the balance sheet of the U.S. consumer in its aggregate, or the balance sheet of the U.S. government, it's like, how do you value the U.S. highway system? I mean, France privatized theirs, for a couple $2 billion, but like you can't value all that stuff really well. But there is a large asset there. We think, and correct me if I'm wrong, but if the market were worried about a debt situation, investors, anything, you would see that in credit spreads. I mean, they would blow out pretty widely. If there was a real concern about that, but you didn't see that even with the downgrade of the U.S. credit situation earlier this year.
No, you didn't. I mean, what do we borrow our money at? I think the U.S. government's average maturity is like 60 months, so 5 years. What's the 5 years at 4%, right? I mean, it's like, there's no massive concern over it. And if you ever did get into the concern, again, you'd have to make adjustments.
Yeah.
It's not, most of what we're going to spend is promises made to future generations. So you'd have to alter those promises.
Yeah. Real quick, your thoughts on the concept of maybe investing some of that Social Security trust fund, which is all sitting in treasuries, to help make the numbers work a little better?
That's an interesting point. I mean, it's a risky one. I guess I think I would rather not necessarily overextend ourselves on how we're investing the Social Security trust fund, and more, you could come at it from one of two ways depending on your politics. If you want to raise the retirement age, you're going to have to do it to people under 50. Just let them know.
Yep.
The other thing is, I mean, the taxable maximum on FICA is what, 180,000?
Yep.
Something Correct. Like that. Why?
Yeah.
Well, if you made it $1 million or you made it unlimited, you've solved your Social Security problem.
Yeah, I think Warren Buffett, has always said, I would pay it back. There's no way to pay it back. I wouldn't pay it back. I think that's how you get them to pay it back 100%, is you say, well, yeah, that cap on Social Security income is increased to $1 million to, whatever.
Or whatever it is. Yeah. I'm sure there's people on the call who don't like me right now, but that's just I'm just saying, I'll never run for office, so don't worry. It doesn't matter to me. But at some point you're just gonna have to make that decision. And the thing about the US, the last two presidents have been 80 years old. So why do they want to make that decision? Leave it to somebody else. Kick that one another decade down. Somebody else will have to make it.
Well, we were right at the top of the hour, and unfortunately, there were a number of questions that were submitted that we were unable to get to. So those of you that are listening, that are watching on YouTube or any of other sites, please be assured that we will reach out to you. If you have any questions, you can definitely click on the link in the description below to get more information. With that, I want to say thank you all for joining us today, and a heartfelt thank you to Brian Levitt for sharing his sharp and data-driven insights and certainly a strategic perspective. As we've all explored the current macroeconomic landscape, emerging trends, and key considerations for long-term long-term portfolio allocation, I hope you gain some clarity to navigate today's market with confidence. So let today's insights fuel your planning, grounded in discipline, anchored by a clear plan, and responsive to the evolving market environment. So we appreciate your time and engagement. If you have any follow-up questions or feedback, please take some time to schedule with our team by clicking in the link in the description below. And once again, if you have any other questions, please don't hesitate to reach out to us. Thank you everyone for tuning in. Have a wonderful evening.